The Senate bill starts 1 year race to build solar. One of the key provisions that maybe folks were a little surprised by in the bill is that there is effectively 1 year from the date of enactment, companies can start construction on a project and claim the full value of the ITC and PTC credits. We think this is going to pull demand forward.
For clean energy, the main good news is that they stripped out a proposed excise tax, which was added in the later stages of negotiations, and effectively it would have hit all wind and solar projects using components linked to China, and it would have effectively kneecapped supply chains overnight.
You're going to need all of these pieces, and I think as the team knows, 95% of the installed capacity, the installed power gen capacity over the last couple of years has been mostly on the alternative and on the renewable side. And we need that. And guess what? We still used significant amount of natural gas as well, because those are intermittent sources.
LNG demand is also relatively subdued due to China's higher domestic production and imports from Russia. So what we're seeing is that despite Europe having to refill a lot more of its stockpiles and the market being tighter from the European point of view, subdued demand in both continents is kind of opening up a little bit of an easing pathway for prices, which we think will continue to play out over the next couple of months.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. For the call today, we've got three regulars from BI that I think most of you will know. So we've got João Martins joining from our office in Madrid, then swinging over to London. We've got Alessio Mastrandria. And then Vince Piazza is joining from Wilmington area. So this is the crew for today, and we're going to kick off with the big news of the moment. If you haven't been following, yesterday the Senate passed its version of one big, beautiful bill. This is the Senate tax and budget package that the Trump administration has been talking about for some time now. This is probably going to be one of the signature pieces of legislation coming from the administration this year. They still have to reconcile the bill with the House version, but there's a lot related, particularly on the clean energy front. So Alessio, let's get you to weigh in. Give us a general sense of what's in the bill. I'll just quickly note we've seen a pretty big rally in the last 24 hours for Vestas, a number of the solar stocks. So why are they moving so much right now?
Sure, thanks, Rob. So after a record-breaking 27-hour session without recess, the Senate finally approved the latest draft of the One Big Beautiful Bill. And as you said before, it now heads back to the House for final approval. For clean energy, the main good news is that they stripped out a proposed excise tax, which was added in the later stages of negotiations, and effectively it would have hit all wind and solar projects using components linked to China, and it would have effectively kneecapped supply chains overnight. That removal was the biggest headline and likely why we saw such a big upswing in Vestas, Array, Shoals, and we're even seeing a bit of an uplift from First Solar and other names. Another good thing about the bill is that the 45X manufacturing tax credits are, at least we now have clarity on them. So for solar, there are still some restrictions from certain entities. So you're not eligible if you get components from China, Russia, and I believe Iran, but they do bring back stackability. So you can claim tax credits from each stage of the production pipeline. So from the wafers to the cells to the modules, they're all still eligible through 2029, and then the phase out goes through, I believe, 2032. On the wind side, they still end in 2027, but at least now we have clarity for which wind projects can go through. And lastly, on the battery front, the credits go through 2029, and then the phase out is between 2030 and 2032 as well.
Fantastic. Thank you, Alessio. For anyone who hasn't seen it, we've got a note out this morning on the wire called Ready, Set, Go. Senate bill starts 1-year race to build solar. One of the key provisions that maybe folks were a little surprised by in the bill is that there is effectively 1 year from the date of enactment, companies can start construction on a project and claim the full value of the ITC and PTC credits. We think this is going to pull demand forward as you see companies try to scramble to get the projects started so that they can safe harbor and make sure that they have full access to the credits. That's a little bit of a difference from kind of how the House would have approached it, and certainly a big change from the IRA. Zhao, you cover a number of the European renewable names. Many of them have exposure to the US. So give us a sense of how they're responding to this development and what you make of the bill.
Yeah, sure. So, I mean, just to contextualize, I guess, current version of the bill that passed the Senate envisions the tax credits, the production tax credits and the investment tax credits, which is what the developers directly care about, being phased out in one of two forms, or terminated in one of two forms. What you just described, if you place a project under construction over the next 12 months, then you have 4 years to finish the project and you'll get the full tax credits. Otherwise, you can still place the project under construction beyond July 2026, but you have to finish it until December 2027 to get the full tax credits. And anything after these two scenarios, you don't get, as a developer, you don't get any tax credits. So at first, this bill seems slightly better than some of the other versions that were going on in the Senate during the discussions, because as you alluded to, it does open up a window for some developers, particularly in solar, which has shorter lead times, to start building and even finish projects before the 2027 deadline. And you can also commit only 5% of capex for certain projects, place them under construction, and finish them after 2027, and still get the tax credit. So whether developers can do that or not will depend on their funding capacities, on how the supply chains operate over the next year, and how much they can source to start those projects. But it is at first glance a slight positive. We, just for context, a project with tax credits can get an IRR of 8 to 9%, a typical solar project, which would translate into at least 200 basis point spread versus the cost of capital of a developer. That makes economical sense. Without tax credits, that would not happen, and that will not happen after 2027 unless PPA prices do go up for solar by $8 to $15 per megawatt. For wind, that's more than $20 per megawatt. So it's a big difference. A couple other comments that I would make is for our peers, for the European developers, this can be a slight positive in the near term, but it's unlikely to change their longer term view of shifting capital away from the US and reducing their investments just because policy is less supportive. And then on a maybe a second comment that I think we can also discuss is this is a little bit contradictory to what the AI story and the growing energy demand potential in the US is. And what we think is that if your clean energy policy is slightly less favorable going forward, but you still need to meet the energy demand, well, something needs to meet that, and it's either going to be gas or at some point we'll have to try and reaccelerate renewable build out.
Okay, thank you, Zhao, for that commentary. Vince, let's get you into the conversation here. I know the bill isn't super focused on the oil and gas names, but there is some stuff that the industry may be using, perhaps some of the credits related to hydrogen, carbon capture. Any broad brush reaction for the oil space as you see this coming down the pipe?
Now, it's unfortunate because there is this friction, right? It's, for whatever reason, it's alternative renewables versus the legacy. And the way I tend to think about this, as Zhao mentioned, we need all of these sources in order to meet that demand, especially the demand on the technology side, which, if everything does come to pass, even a fraction of what we expect that demand to be, it can't be met solely with the natural gas, and it can't be met solely with solar or wind. You're going to need all of these pieces. And I think, as the team knows, 95% of the installed capacity, the installed power gen capacity over the last couple of years has been mostly on the alternative and on the renewable side. And we need that. And guess what? We still used significant amount of natural gas as well, because those are intermittent sources, and you need that persistent 24/7 redundancy that natural gas brings to the table, whether it's hooked up to a utility or if it's behind the meter on site facility. You're still going to need that redundancy. So what is good for solar and wind is actually very good for natural gas, since we definitely need more of it, and we need more of all three. So I know that probably gets me in hot water with some of our friends down in the oil patch, but that is the reality. I'm not taking a political view. I'm just taking just a legitimate. I hug the 50-yard line, and I want the right answer. The right answer is you need all of these things to make it work.
Vince, you're preaching to the choir a little bit here, in my opinion. And my general sense is that with or without subsidy, the solar industry has a pretty bright future. And as Zhao was just mentioning, without the subsidy, the price has to calibrate at a slightly different level. But I think we have entered the era of cost competitive renewables. And so you're going to see a lot of partnership with wind and solar and gas and storage. And we're just going to see all of the above. I think it's going to be a theme of the next 5 years. And one of the reasons that a lot of companies will probably be interested in solar in the short run, and batteries in particular, is just simply because there's a long backlog for gas turbines. So if you need new generation, you probably are going to turn to something that you can build quickly. And, solar is the fastest out of the gate. Batteries are fastest out of the gate. You're looking at much longer lead times for wind or gas. But we are in a world of rapidly rising power demand because of AI data centers and other factors. And so I think we're going to see a proliferation of these technologies just simply because of the sheer economic need. And you can somewhat almost sort of not think super deeply about the policy. Vince, give us your sense. We're in mid-year outlook season. And so you and really all of us, for our individual sort of sectoral focuses, have been putting out our mid-year outlooks. You've got 2 under your belt. So let's start with gas, since you were just there, kind of speaking about how the gas interplays with renewables. But just give us a sense, what's your expectation for gas market fundamentals? How's it read into the E&Ps as you look into 2H?
Well, I think luckily for us, there really hasn't been much that we needed to change. I don't really look at things in 6-month increments. I look at things in terms of cycles. And I tend to write these outlooks, even though they are in 6-month chunks. I tend to write them more from a structural and secular growth perspective. The future is bright for nat gas, even with growth in renewables and alternatives, for a lot of the reasons that Yao mentioned. We need the stuff. We actually hit a relatively new high on natural gas output. We need that output in order to meet those demand needs, especially on the LNG side. We have a significant transparency for feed gas demand through 2030. We have significant transparency on the AI side through 2030 as well. We're not as bullish as a lot of the street is, But even if it is close to the lower end of that range, you're looking at tighter markets, looking at tighter balances, and what you need is higher price to incentivize producers to produce. And the one name that I would mention that is key to this whole thing is Expand Energy. They recently, well, they are recast. They have rebranded. They are the amalgamation of Chesapeake and Southwestern, two key operators in the Marcellus and Haynesville, two key operators in regions of the country that have both a plentiful resource and near critical demand hub. So I think what we're going to see, and this is part of the outlook that is consistent over time over the last several years, is we need fewer E&Ps, but larger E&Ps. We have capital constraint. They have maintained their capital discipline. Although we have growth in production, we will not see the growth in production in 2026 that we saw in 2025. But what we will see through 2026 is a growth in demand, which will tighten balances. We're on the record for $4 in summer. We're on the record for $5 by the end of December, and we'll stick with that, and we can talk more about that. The last thing I would say, though, Rob, just in fairness, just getting back to the issue of renewables and alternatives, if we're going to give the upstream industry massive credits to defer costs via intangible drilling costs, then the other industry that is in competition with it, not really in competition, they should have their credits as well. They should have their tax incentives to do their job as well. Either treat both industries equally or take it both away. So I think that's just from a fairness perspective, that's my last comment on that.
Thank you so much, Vince. Zhao, I want to come over to you next and get you to give us your perspective on the European side of the gas equation. But before we do that, let me just advertise quickly for anyone listening. We have an in-person event in London 1 week from tomorrow, so July 10th. Hope you will join us at that. And then 1 week from that date, on July 17th, we have an in-person event in Madrid. We're going to be talking about a lot of these same themes. So if you want to join us in London, Madrid, we've got a few other European cities as well. I won't mention because I know we have some concentration in those two places. But if you're in either one of London or Madrid and you want to join us for an in-person discussion along these lines, just IB any one of us and we're happy to help get you the details. So Zhao, give us a sense though. We just heard Vince talk about the North American gas perspective. How are things looking in Europe for 2H? And how does gas frame relative to renewables over in Europe here at the moment?
Yeah, sure. So first, what we've seen over the last 2 weeks is gas prices in Europe easing quite a lot since the highs from the headlines of tensions in the Middle East. That is reflective or supports our view, our bearish view of European gas markets going into the end of the summer. And that's supported by a few different things. Number one, in Europe, underlying demand remains relatively weak, largely driven by weak industrial activity. And second, in Asia, which is our key competitor for LNG, LNG demand is also relatively subdued due to China's higher domestic production and imports from Russia. So what we're seeing is that despite Europe having to refill a lot more of its stockpiles and the market being tighter from the European point of view, subdued demand in both continents is kind of opening up a little bit of an easing pathway for prices, which we think will continue to play out over the next couple of months. What this means for utilities, or in particularly for gas utilities, is mostly on the supply side. We think margins could be relatively subdued, although these companies also have to procure a lot of their supplies, which might, and those procurement costs might be gradually easing for the group. And then the second side of our earnings outlook for gas utilities, which is the most important one, is a lot of these utilities manage their regulated assets. The way they grow their earnings is by investing more in their assets and expanding capex, and that's where we see a big discrepancy versus power utilities, and not necessarily renewables, but just utilities that invest in regulated power assets. What we're seeing is utilities shifting investment to power grids, whether it's from renewables to power grids or from different types of assets to power grids. That's where growth is shifting a little bit towards in Europe. And that means power grids are power utilities may grow faster than gas utilities over the rest of the year and into 2026, 27. Overall, for the sector, consensus is about flat earnings this year, which we think might be conservative, given the, as I mentioned, the mounting investments on regulated assets, and on the other side, stabilizing energy costs, which might aid margins for integrated peers. That means that we see about 200 basis points of upside for earnings this year versus consensus.
Thank you, Zhao. So we have a few questions, and so feel free to drop them in and we'll try to get to them. There was one question on safe harboring, which I'll just quickly touch on. So I think what you're going to see is that you basically have a 1-year window from date of enactment. So let's say sometime in the next few weeks, most likely, where you're going to see companies try to start construction. And I think definitionally they have to spend 5% of their CapEx. So within that 1 year, you're going to see companies rush to spend 5% of their CapEx to start construction on a project. And then they have a 4-year window to complete those projects, and they can fully capture the tax credits as they were in the IRA. Now, if you don't start within the next 12 months from enactment, then you can still safe harbor, but you have to be online by the end of 2027, from my understanding. So you got a lot of incentive to really try to accelerate things in the next 12 months versus even coming in just a little bit later based on the way the tax policy is written. So keep an eye on this space. Alessio, I want to come over to you and just get bigger picture perspective on solar. The US is an important market, but it's not the only one. So just read the tea leaves. How does solar look in light of this? And there was a question in the chat about solar plus storage. So if you could maybe frame kind of how storage and solar are both pairing these days, that would be very helpful. Thank you.
Sure. So our mid-year outlook came out yesterday, and we bucketed the outlook for solar in 3 different ways. So one, robust solar demand. Globally, we're going to see about a 20% increase in solar installations in 2025. So we're going to cross about 700 gigawatts just this year. Last week, we were talking about how China installed 90 gigawatts in 1 month. That's very fast paced, but it is notably slower than the 2020 to 24 pace, which was growing at about 40% per year. I would say we still give that a green box. The second bucket, we already kind of covered the clean energy incentives. It's good that we have clarity. It's good that we don't have the excise tax, but it's still maybe not as good as it was in the original version of the Inflation Reduction Act. And then third, we do have some tariff risk now that we're coming up on the 100-day pause. I know that's a bit of a US-centric view, but globally, it is worth knowing that a lot of Chinese firms have slowed down their production. There was a headline this morning saying, the factories are going to slow down just because we're seeing such low module prices. I think we hit a floor of about 9 cents per watt, and we can see that number either stay at the 9 cents or potentially rise up a little bit, which could then help margins. On a top line perspective, we're likely going to see some good growth, but that's likely because of a low comp to last year. Everybody that we cover, except for First Solar, is likely going to see that growth. But First Solar is the only one that's going to see continued record growth just because of their strength, their backlog, the moat around tariffs and imports, and the fact that they're insulated from polysilicon production.
Thanks, Alessio. There is a question in the chat just asking about, if we are going to see an acceleration of projects over the next 12 months, whether that could increase the cost profile. And I think, yeah, like all things being equal, that's a pretty logical conclusion. I think the one cautionary thing I would say in response to that is just that at least globally, there is an excess capacity to produce much of the equipment that's flowing into the solar supply chain. So modules, for instance, we are probably going to install something like 700 gigawatts of modules globally this year. Massive numbers. But we have the capability to produce 1,200, 1,300 gigawatts of modules if all factories were running at full tilt. So even if there's a little bit of bump up in demand, from a global perspective, there's a lot of capacity. Now, as Alessia was just mentioning, tariffs, lots of other things that sort of affect where all the modules can flow to. So maybe there could be some pressure on U.S. supply chain if there is a bump up in demand, but let's keep an eye on it and see how it goes. Vince, I want to swing back over to you. One of the questions in the chat is just how to reconcile your sort of quite optimistic, positive view on gas relative to the bit more tepid outlook from Zhao, and just want to in Europe, and I want to sort of get your take on the bifurcation between the two markets.
Yeah, so the way I would characterize one significant piece of it is we have production growth here in the U.S. Slowing because of the operator discipline. Year over year, growth was a lot higher. Coming into the second quarter, we have slowed quite a bit. So we're less worried about production growth. We're also less worried about the demand side of the equation. We think that the power gen is going to be there because of this build out on the technology sector side. In the interim, the seasonality factor, the molecules are needed to flow overseas. I think storage, and Zhao may offer more detail on this, but we're somewhere around 58-59% filled on gas storage right now. I think that there is a need to fill sooner rather than later. If we get a hotter summer across the pond, that will likely hurt that pace of refill on storage. But we are an ally, and we are where the molecules are. We do have the molecules, and we are an ally as opposed to a less dependable source from Russia. So the operator discipline is going to be there because the capital discipline is there. The investor base has said, I do not want to see production growth. What I do want to see is the free cash flow, and I want to see the excess cash coming back to me. So that is a limiting factor for growth. And on the demand side, you have the seasonality factor, but you also have the longer term structural demand and the transparency there that is going to be needed to fill that feed gas demand, and also the AI demand as well.
Thank you, Vince. Before we circle back and talk about some of the additional questions that have been coming through the chat, I do want to move and just get a quick take on the oil side of the equation. We held 2 rapid response webinars earlier this summer following the escalation of tensions in Iran And so I think there was a lot of intense focus on the oil market. And just looking here today, it looks like Brent's about $67 and change. So a lot of that geopolitical risk premium seems to have evaporated pretty quickly. And I want to get your sense on kind of, what's second half look like for the oil market, and how do you read into what that means for the U.S. Oil patch?
Yeah. So I think even before the most recent geopolitical events, we had mentioned that we felt production peaked. In fact, production peaked back in 4Q, quite honestly. Prices most likely peaked as well. I think OPEC is back in the driver's seat too. Pushing more barrels or more capacity out there sort of limits the upside for crude in general. I think the operator discipline is also there. That's also a limiting factor. That is a guardrail for the industry. The consolidation is a focus. Even with this mid-60s, further out in the curve, there's a 70 handle there at some point. That seems to be a price that doesn't dislodge M&A conversations. In fact, I wouldn't be surprised if we see an acceleration, just given where we think rates are headed as well. So that may make capital a little less costly, especially the debt capital, perhaps. I happen to think that the free cash flow story, free cash flow yield story is going to dominate, and less is going to be more. So less output is going to take precedent still. If operators can push the message of discipline and greater excess cash coming back to the investors, I think that's a better message, and I think that moves the needle incrementally. But this sector is still in maturing phase. It still is 3% of the overall index. If you exclude Chevron, Exxon, and ConocoPhillips, the rest of the space, the rest of the 24 names hardly move the needle. So in our conversations with PMs, a lot of them tell me, I don't need to be there. I can make my play with one of the larger names, and that's more of a defensive side of the ball, and stand pat and work my magic elsewhere in adjacent type industries related to energy, whether it's an AI type play or a derivative of that type of play.
Thank you, Vince. Made me chuckle a little bit. I was just going to see if I could respond on, what share of the index is clean energy right now, and it's much closer to 0 than 3%. In the S&P 500, you've only got First Solar in the index right now, and Enphase, despite the rapid growth from the industries. Solar Edge, I think, used to be in, but they got dropped recently after some of the recent trouble in the last couple of years.
The entire energy sector peaked out at somewhere around 15-16% during the commodity super cycle. So from, staring at 3%, it's a long look up, man.
Yeah, indeed. And I think a lot of the change in the index is related to like the rise of AI and all of these other things, as opposed to sort of energy completely taking it on the nose. Although it's been a difficult, or sort of challenge year, I suppose, depending on which segment you're looking at. Alessio, let's address some of the questions in the chat before we wrap this up. I want to come to you next and just get a quick read on the offshore wind business. And, I think certainly in the US, it's probably a difficult time, but give us a read. Does the Senate bill change anything for that? And what's your general take on how offshore is going to fare over the next couple of years?
So prior to the election, we had a pipeline of about 30 gigawatts of offshore projects in the US. That was through 2030. I think offshore wind takes another hit thanks to the Senate bill. The ITCs and PTCs require projects to either be placed in service by the end of 2027, like you were saying, or at least started by within 1 year. Given the long lead times of offshore wind, it seems unlikely that these projects are going to go ahead, or if it's even worth doing the investment to build up the supply chains in the US. On top of that, the 45X tax credits, the blades and nacelles, that also ends after 2027. So I think projects that are deep within the pipeline are already permitted and under construction now are likely to go ahead. But I foresee that 30 gigawatt pipeline drying up before the end of the decade. In Europe, that's going to be likely a very different story. Companies like Siemens Energy are still going to continue to dominate within Europe, but I think the US, it's going to be unlikely to see much growth there.
Thanks, Alessia. Zhao, I want to get your perspective on that as well. There was a time when European policymakers were talking about tremendous expansion in offshore wind and using the wind to run electrolyzers to create a hydrogen economy. It was a very sort of interesting vision of what the future could look like, but I don't think we've made much progress. But give me a sense, how's offshore wind faring in Europe?
That's right. I think definitely more uncertain than before as well. Perhaps not as bad as in the US, but the recent offshore auctions that we've had in Europe as well were not very successful. Both in the UK and Denmark last year, they were not able to, in the UK, a round of auctions for CFDs to award CFDs for new projects, and in Denmark an auction to award new offshore projects. Both weren't successful, didn't attract any new projects, and that's reflective of more difficult economics for the projects themselves, and perhaps demanding higher PPAs that governments are not willing to, at this point, to award, because also governments in Europe are trying to contend with high energy bills for end customers, and so there's a little bit of a contradiction there. So I think in Europe as well, the story is a little bit more negative than before, although just taking a policy target point of view, nothing has changed, and governments theoretically still remain committed to their targets. That's not, we're not seeing the practicality of that in policies, and maybe next year will be very important, because there will be a couple of new auctions that will probably show the willingness of governments to support the sector.
Thanks, Zhao. One last question that I'll maybe take is just which market on the margin could be most affected by the changes, and specifically pointed at California market or Texas market. And, my general view is California as a state is probably going to remain very committed to its vision of renewables. And so you'll probably continue to see strong state support in California. If you don't know the nuance there, they recently rolled out what they call a NEM 3.0 net energy metering policy that gives pretty generous subsidies for folks who want to do rooftop solar. Big change was that now to get the most generous subsidy, you also have to do batteries. And so I think states like California and other more left-leaning states will continue to provide some level of state support. I think in a place like ERCOT, it's, while the change is maybe has some impact there, I think one of the pieces that renewables have been growing so fast there is that power demand has been just absolutely ripping in Texas, partly because of data centers, but also because of just general industrial activity. And so, I think those conditions aren't likely to change as a result of the bill. To give you a sense, next year in the US, we see something like 9.5 gigawatts of data centers coming online. That's a a fairly robust number. On the low end, we think it could be something closer to 5 gigawatts. On the higher end, 14 gigawatts. And I think if you look at the actual pipeline for projects that's slated to come online next year, close to 9 gigawatts actually started construction. So, and a lot of that data center capacity, for anyone who's been following, is in markets like ERCOT. So I think that we are going to continue to see some of these structural factors helping to drive that all of the above vision that Vince was describing, that really steps back from any of these policy changes or nuance we've been discussing. So let's keep an eye on it. For anyone who's happened to find this call for the first time, we get together every Wednesday at 10 a.m. New York, 3 p.m. London to not just talk to this group, but the broader team from Bloomberg Intelligence. And also we regularly host external speakers as well. So feel free to join us every week, share the word. If you've got any topics or speakers you want us to have on, just ping us, let us know, and we'll try to make it happen. So take care, everyone. Hope you have a great rest of your week. And once again, if you are in Europe and you want to join us in London, Madrid, or any other European city, just ping us and we'll try to get you all the details on that. So take care, and we look forward to seeing everyone next week. Thanks a lot, guys.